Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for the segment, we have Shannon Saccocia. She's the Chief Investment Officer at SVB Private to discuss asset allocation and if 2023 will be another year of equities volatility. Shannon, it's great to have you with us. Welcome to Trade Talks.
Oh, thanks so much for having me.
And that certainly is the million, billion, trillion-dollar question. Do you expect another year of heightened volatility in 2023?
Absolutely. We are still, grappling with the increase in rates that we experienced last year. We know that not all of that has been appropriately transmitted throughout the economy. And investors right now are sort of shifting from this concern about kind of the longer tail effect of higher interest rates and what does a recession potentially look like in late 2023 and into 2024? And so there is a lot of re-rating going on, particularly around earnings. And I think that that's going to continue to weigh on valuations and really force investors to be very thoughtful about how they're allocating their capital in 23.
Yeah, I'm glad you brought that up because another question I have is, do we start to move to fundamentals and away from macro a bit in 2023? It seems as if the market's just so predisposed to what's happening with the Fed, with rates, geopolitics, and we really haven't thought about what corporates are going to look like yet.
Well, I mean, it's been really difficult, right? Because we had 10 years prior to the pandemic where nobody thought about fundamentals in a low interest rate, low growth environment. There was so much balance sheet manipulation. There was so much financial asset manipulation, if you will. Companies were really not forced to be all that lean or execute all that well in that type of environment. We moved into the pandemic. Obviously, a huge reset in terms of management teams and what they were focused on. And now we move into 2023. I hear this call for a return to fundamentals. And although I think 2022 was absolutely kind of a macro overhang type year, you start to think, do we really know how to invest on fundamentals anymore? Is there, even when you see pockets of that, when you see some bifurcation, some dispersion in trading, CPI comes out or the Fed says something, everything trades together again. So I do think what we're going to have are probably bouts of correlation among sectors as we move through 2023. But I do think that there are going to be some opportunities, particularly as we go into the second half of the year, based on that management execution and resilience.
Yeah, it's such a great point that you bring up because this term that came up in the 2010s and early 2020s, there is no other alternative. To your point, that doesn't sound like an investment thesis, relative to analyzing core fundamentals. Let's talk about fixed income for a moment. Do you think the bond market can absorb economic headwinds into the next year?
So our view is that this will probably be a better year for bonds, although obviously we don't think we're maybe quite at peak interest rates yet, or at least according to the Fed telegraphing, we're not quite at peak interest rates yet. There's a lot of concern. If you go back prior to the pandemic, we kept talking about this wall of worry, like all of this BBB investment grade debt that was going to have to refinance at higher rates. We never really ran into that wall. We could be entering into a period where we do start to see a potential tick up in defaults. I actually think that that's an opportunity because unlike 2020, where the Fed once again swooped in and really created this foundation or floor for the credit market, a lot of what I would say lower quality issuers are going to be faced with over the next couple of years is really an emphasis on their leverage ratio, an emphasis on their balance sheet. That's actually a great environment to be able to move away from government bonds, which I think is where everyone's sort of sitting from a safety perspective right now, from a yield perspective right now, into corporate debt, which I do think presents an opportunity over the next couple of years.
So with this backdrop, how are you positioned?
So we neutralized, we had been overweight equities, which I think many of us were for a very long time, given your point about bonds were really quite the inferior alternative, especially in this inflationary environment in 2021 that we were experiencing. But we really reset sort of mid-year last year and neutralized our equity overweight because we did believe that there was certainly some value, especially in the short end of the curve. I would say going out over the next 12 to 18 months, we're really looking at our overall equity exposure, looking for opportunities, particularly in the United States. We think that, the lack of independence from an energy perspective in Europe is going to continue to be a challenge. We're not quite sold on Chinese reopening just yet. We think there's going to be some fits and starts there, particularly with common prosperity. But we do think that taking on a little bit more duration, taking on a little bit more credit risk in the fixed income markets, being able to be very targeted in terms of U.S. equity exposure, looking outside of Europe, outside of, maybe looking back at Japan potentially over the course of the next couple of years. And then in the alternative space, thinking about, are there opportunities to take advantage of what is going to be a continued inflationary environment in our view, maybe not 5%, but certainly not 1.5%, and being able to invest in some real assets that are positively correlated to inflation over the next couple of years.
All right, Shannon, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.